You are in Bali. The crypto market is moving. You want to fund your account before the price changes again. You see three possible options: bank transfer, card, e-wallet. They look like three different ways to complete the same transaction. They are not. One method can move up to 250 million rupiah in a single fast retail transfer, with the customer fee capped at 2,500 rupiah. One QR-based payment is limited to 10 million rupiah per transaction, and one registered electronic money account can hold no more than 20 million rupiah, with monthly incoming transactions limited to 40 million rupiah. Same country, same smartphone. Three radically different transaction limits. Now imagine you want to fund a 100 million rupiah crypto purchase. Through the fast bank transfer infrastructure, the amount may fit within one transaction. Through a QR-based channel, the amount exceeds the maximum transaction limit and would require at least 10 separate payments, assuming the platform and payment provider even permit that structure. Through a registered e-wallet, the amount exceeds the national monthly incoming limit. And through an international card, the transaction may not be supported at all. This is why the best funding method is not simply the fastest button on your screen. It is the method that matches your legal identity, your banking access, your transaction size, your documentation, your cost structure, and your withdrawal plan. In this video, I will show you why Indonesia's payment infrastructure matters to crypto investors, how bank transfer, card, and e-wallet funding differ, which method usually works best for small, medium, and large purchases, what foreign clients must prepare before sending money, and how to avoid paying unnecessary fees or creating a compliance problem before buying a single crypto asset. The investment begins when the trade is executed, but the transaction risk begins when you choose how to fund it. Let's break it down. Bali is one of Indonesia's most internationally connected markets. During 2025, Bali recorded nearly 6.95 million direct foreign visitor arrivals. That was an increase of 9.72% from the previous year. Australian visitors alone represented 23.44% of the total. That international population includes tourists, long-term expatriates, digital nomads, business owners, foreign investors, and directors or shareholders of foreign-owned Indonesian companies. Many of them arrive with financial systems built outside Indonesia. They may hold funds in a foreign bank. They may use an international card. They may already own crypto assets. They may receive income from an overseas company. Then they enter an Indonesian financial ecosystem built around rupiah, local payment infrastructure, identity verification, and regulated service providers. That creates a gap between what the client owns and what the local system can accept. A foreign card may work for a hotel. It may not work to fund a regulated crypto account. An international e-wallet may work for online shopping. It may not connect to an Indonesian deposit route. A foreign bank may be able to send money internationally. But the receiving crypto platform may only accept designated domestic payment channels. The problem is not access to technology. The problem is compatibility between financial systems. This funding question matters because Indonesia's crypto market is no longer small. As of April 2026, regulated digital financial asset traders reported approximately 21.70 million consumer accounts. Crypto transaction value during April alone reached 22.98 trillion rupiah. Across the full year of 2025, Indonesia recorded approximately 482.23 trillion rupiah in crypto transactions. By April 2026, OJK had approved 32 licensed entities within the crypto trading ecosystem. These included 2 exchanges, 2 clearing and settlement institutions, 2 custodians, and 26 digital financial asset traders. OJK had also approved 7 supporting payment service providers. This final category matters. Crypto purchases do not exist independently from the payment system. The crypto platform manages the digital asset transaction. The payment infrastructure moves the rupiah. A successful purchase requires both systems to work correctly.
When you fund a crypto purchase in Indonesia, you interact with two regulated systems. The first is the Digital Financial Assets System. It covers trading platforms, crypto assets, custody, clearing, transaction settlement, governance, and consumer protection. The second is the payment system. It covers bank accounts, fund transfers, payment cards, electronic money, QR-based payments, and payment service providers. Since 10 January 2025, supervision of digital financial assets, including crypto assets, has operated under OJK, with Bank Indonesia receiving responsibility for areas within its authority. Bank Indonesia continues to supervise Indonesia's payment system. The funding process therefore crosses a regulatory boundary. First, money moves through a regulated payment channel. Then it enters a regulated digital asset account. A funding method may be valid within the payment system but unavailable on a particular crypto platform. A platform may accept electronic money, but only through selected approved channels. A payment instrument may theoretically fund a QR transaction, but the platform or issuer may apply lower limits. This is why seeing a payment option does not automatically mean it will work for every foreign client. The regulatory and supervisory responsibilities for digital financial assets transferred to OJK and Bank Indonesia on January 10, 2025.
The infrastructure supporting these payments is already operating at enormous scale. In May 2026, Indonesia recorded 5.22 billion digital payment transactions. That represented growth of 28.14% from the same period 1 year earlier. QR-based payment volume grew 95.10% year-on-year. Indonesia's fast retail payment infrastructure processed 518 million transactions during May alone. Those transfers had a combined value of 1,265 trillion rupiah. The first quarter of 2026 shows the same direction. Indonesia recorded 14.82 billion digital payment transactions during the quarter. That was an increase of 37.69% year-on-year. QR-based transaction volume grew 116.43%. Fast retail payment infrastructure processed approximately 1.4 billion transactions worth 3,519 trillion rupiah. This tells us two things. First, Indonesia is not lacking digital payment infrastructure. Second, the problem for international clients is not whether digital payment exists. The problem is finding the correct route into that infrastructure.
For most foreign clients who have legitimate access to an Indonesian bank account, bank transfer is usually the strongest default funding method. It offers four major advantages. First, ownership is easier to verify. The sender's name can be compared with the identity on the crypto account. Second, the transaction creates a clear record. The amount, date, sender, receiver, and transaction reference can be documented. Third, bank transfers can accommodate larger amounts than electronic money or QR-based channels. Fourth, the transfer cost can be relatively low. Indonesia's fast retail payment infrastructure operates 24 hours a day, 7 days a week. The maximum individual transaction value is 250 million rupiah. The maximum customer charge for an individual credit transfer is 2,500 rupiah. That does not mean every crypto platform accepts deposits up to 250 million rupiah. The platform may impose a lower limit. The customer's bank may apply risk controls. The account may have a daily transfer limit. But the underlying payment infrastructure provides significantly more capacity than a standard electronic money wallet. For serious investors, this matters.
Now look at the economics. Suppose an investor wants to fund a 100 million rupiah purchase. A bank transfer route using a fixed 2,500 rupiah customer fee would represent 0.0025% of the transferred amount. Now compare that with a hypothetical payment channel charging 1%. 1% of 100 million rupiah is 1 million rupiah. The difference is 997,500 rupiah before the investor buys any crypto. This example does not claim that every non-bank payment method charges 1%. Fees vary by provider. The point is mathematical. A fixed fee becomes more efficient as transaction size increases. A percentage fee becomes more expensive as transaction size increases. That is why the cheapest method for a 2 million rupiah purchase may not be the cheapest method for a 200 million rupiah purchase. Never compare only the number of steps. Compare the net amount that reaches the trading account.
Bank transfer is not automatically suitable for every foreign client. The client must verify whether the platform accepts foreign users, whether the client can lawfully open and operate the relevant bank account, whether the bank account name matches the verified crypto account, whether third-party transfers are prohibited, whether the platform uses a direct transfer or virtual account, whether the payment reference must contain an exact number, and whether the transaction requires additional source of funds documentation. For a larger transaction, the platform may ask, where did the money come from? Was it salary, business income, investment proceeds, property income, a loan, a shareholder contribution, or the sale of another asset? These questions do not mean the transaction has failed. They mean a regulated provider is applying customer due diligence. A clean bank transfer, with weak supporting documentation, can still face review. The payment record explains where the money moved. Source of funds documents explain why the client controlled it. Bank transfer is usually best for medium and large purchases, recurring investment activity, clients with verified Indonesian banking access, transactions requiring strong documentation, and properly structured corporate activity. Its main weakness is accessibility. A newly arrived foreigner may not yet have the required local banking infrastructure. When that infrastructure exists, bank transfer is usually the most defensible route. Electronic money offers a different value proposition. It is designed for convenience. It can support small deposits, mobile transactions, test purchases, and users who already have a fully verified local electronic money account. But convenience has a regulatory ceiling. Bank Indonesia sets the maximum stored value for unregistered electronic money at 2 million rupiah. For registered electronic money, the maximum stored value is 20 million rupiah. Monthly incoming transactions are limited to 20 million rupiah for an unregistered account and 40 million rupiah for a registered account. The payment provider can impose lower limits based on its own risk management. These limits immediately affect suitability. A client seeking to fund a 3 million rupiah purchase may find electronic money practical. A client seeking to fund 100 million rupiah purchase cannot assume that one registered wallet can support the complete transaction. The funding method must fit the transaction size, not merely the client's preference. A foreign client should also distinguish between installing an e-wallet and qualifying to use its full features. An application can be downloaded in seconds. Verification may require a supported identity document, a local telephone number, residence information, facial verification, or additional customer data. An unregistered account carries lower limits. A registered account offers higher capacity but requires stronger customer identification. The exact foreign user requirements depend on the provider. Therefore, the practical question is not, can I download an e-wallet? The practical question is, can I verify it under my own identity and use it for the required amount? Some crypto funding routes may use Indonesia's national QR payment standard. This creates another misunderstanding. A QR transaction may draw funds from a bank account, a debit instrument, a credit instrument, a credit facility, or server-based electronic money. But the availability of each funding source depends on the payment provider and its approved product structure. A QR code does not guarantee that a foreign-issued credit card will work. It does not guarantee that an international payment application is supported. It does not remove identity requirements. And it does not remove transaction limits. Bank Indonesia limits QR transactions to a maximum of 10 million rupiah per transaction. Payment providers may impose lower daily or monthly cumulative limits. For a 5 million rupiah test purchase, this may be practical. For a 100 million rupiah purchase, the QR limit becomes a structural problem. 10 separate transactions would be required merely to reach the nominal amount. The platform may reject repeated funding. The payment provider may apply a cumulative limit. And compliance teams may ask why one transaction was artificially divided. A limit is not an invitation to design around the limit. Electronic money is usually best for small deposits, test transactions, mobile-first users, and clients with an existing verified local account. Its weaknesses are balance limits, monthly limits, potential percentage-based costs, foreign user eligibility, and limited suitability for corporate or high-value activity. It is useful. It's not universal.
International clients often assume card funding will be the easiest method. That assumption is understandable. Cards work for flights, hotels, restaurants, online subscriptions, and international retail purchases. But crypto funding creates different risks for the issuer, payment provider, and receiving platform. A direct card deposit function may not be available. A foreign-issued card may not be accepted. The card issuer may restrict crypto-related transactions. The payment may be subject to foreign exchange costs. The transaction may require additional authentication. The name on the card may need to match the verified crypto account holder. A credit card transaction may also introduce questions about borrowed money being used to purchase a volatile asset. The card may be technically capable of making a payment. That does not mean the full transaction route is commercially, operationally, or legally supported.
Cards can also create a hidden cost stack. The client may face currency conversion, a foreign transaction charge, a card processing cost, a platform funding charge, a trading fee, a spread between the displayed market price and execution price, and a future withdrawal cost. Suppose the client begins with Australian dollars, converts through an international card network, funds a rupiah account, buys a crypto asset, and later sells back into rupiah. The investor may experience costs at several stages. The platform's trading fee is only one component. A low trading fee cannot compensate for an expensive funding route. For every method, calculate original funds, minus conversion costs, minus payment costs, minus platform funding costs, minus trading costs, equals the actual value of crypto acquired. That final number matters. The advertisement does not.
A card should not be the default assumption for funding crypto in Indonesia. Use it only when the regulated platform explicitly supports it. The card issuer permits the transaction. The client's identity matches. The currency conversion cost is understood. And the complete fee structure is acceptable. A familiar payment method can still be the wrong financial route. Here is the practical comparison. For a small purchase, an e-wallet or QR-based channel may offer the fastest user experience. For a medium or large purchase, bank transfer usually provides better capacity, stronger documentation, and lower relative cost. For a client relying only on a foreign-issued card, the transaction remains conditional. The platform, issuer, payment provider, currency, identity profile, and risk controls must all support it. Therefore, the winner depends on the objective. Best overall for structured funding, bank transfer. Best for a small test purchase, verified electronic money or an approved QR route. Best for a newly arrived client with only a foreign card. None can be assumed. The client must first identify a supported, compliant funding path. That answer may be less exciting than recommending one universal button. It is also more accurate.
A foreign investor has just arrived at Bali Airport. They have an international card. They do not have an Indonesian bank account. They do not have a verified local e-wallet. They want to invest the equivalent of 50 million rupiah. The card feels like the obvious solution, but the client must verify whether direct card funding is supported. If it is not, an informal intermediary may offer to receive the card payment or foreign transfer and send rupiah into the crypto account. That creates several risks. The funding source no longer matches the account holder. Pricing may be unclear. The intermediary may not be regulated. The client may have no formal complaint process, and the transaction record may not clearly explain how the money moved. The correct action is not to force the transaction. The correct action is to identify which regulated routes are available for that client's identity and banking profile. Sometimes the best immediate decision is not to deposit. It is to build the correct infrastructure first.
An expatriate living in Canggu wants to invest 20 million rupiah every month. The client has a verified Indonesian bank account, a verified crypto account, and a clear source of income. For this client, bank transfer is usually the strongest route. The transaction can be repeated. The bank account name can match the crypto account. The cost can be measured. The records can be retained. An e-wallet may also hold up to 20 million rupiah when registered. But using the entire maximum wallet balance for one monthly crypto purchase creates less flexibility. The monthly incoming limit is 40 million rupiah. A bank transfer offers greater capacity and usually creates a cleaner recurring process. The right comparison is not which method saves 10 seconds today. It is which method remains efficient after 12 months.
APTPMA wants to purchase digital assets using company funds. A director proposes using a personal e-wallet because it is faster. That creates immediate problems. The company is the intended owner of the asset, but the funding account belongs to an individual. The crypto account may also belong to an individual. The payment record does not clearly show a company purchase. The accountant must then explain why company funds moved through a personal account, who authorized the transaction, who legally owns the crypto, how the asset should be recorded, and whether the activity fits the company's permitted business and investment framework. For corporate activity, convenience is not the primary test. Governance is. The company should assess corporate authority, bank account ownership, legal entity onboarding, accounting treatment, tax implications, source of funds records, beneficial ownership, and internal approval. A properly documented company bank transfer will usually be more defensible than a personal wallet or card. But every PTPMA must obtain advice based on its own legal and tax position.
Before funding any crypto purchase, answer 7 questions. Question 1. Who owns the money? Is it personal capital, company money, investment proceeds, borrowed money, or money belonging to another person? Question 2. Who owns the crypto account? The owner of the payment method and the owner of the trading account should align with the provider's requirements. Question 3. Is the payment method explicitly supported? Do not infer support from a logo. Verify the actual funding route. Question 4. What is the total cost? Include currency conversion, transfer cost, payment channel cost, deposit cost, trading fee, spread, and eventual withdrawal cost. Question 5. What limits apply? Check per transaction limits, daily limits, monthly limits, wallet balance limits, bank transfer limits, and platform account limits. Question 6. What documentation may be required? Prepare identity documents, proof of account ownership, source of funds evidence, business records, and transaction explanations where appropriate. Question 7. How will the money come out? A funding route is incomplete until the client understands the withdrawal process. How will the crypto later be sold? Which bank account can receive the rupiah? Do name matching rules apply? What are the withdrawal limits? What records will be available? Never design only the purchase. Design the complete life cycle.
A useful funding decision should be scored across 5 categories: accessibility, capacity, cost, compliance, exit. A method that scores highly on speed but poorly on capacity is not suitable for a large transaction. A method that scores highly on convenience but poorly on compliance is not suitable for a company. A method that accepts the deposit but cannot support the intended withdrawal is not a complete solution. The highest scoring method is not necessarily the most modern. It is the method that creates the least unnecessary friction across the full transaction.
A proper consultation does not begin with use bank transfer, use a card, or use an e-wallet. It begins with the client. What nationality do you hold? What is your Indonesian residency status? Are you acting personally or through a company? Where are the funds currently held? What currency do you hold? Do you have an Indonesian bank account? Do you have a verified local electronic money account? What amount do you want to invest? Is the transaction one-time or recurring? Can you document the source of funds? How will you eventually withdraw? Only after answering these questions should the available funding methods be compared. For one client, bank transfer will be obvious. For another, electronic money may be sufficient. For a newly arrived foreigner, no immediate route may yet be appropriate. Good guidance does not force every client into the same answer. It identifies the answer supported by the client's actual facts. Sungeza Live helps foreign clients understand Indonesia's digital asset and payment ecosystem. The consultation can include reviewing the client's profile, comparing regulated funding routes, identifying payment and account limitations, estimating the complete transaction cost, preparing identity and source of funds records, planning a controlled test transaction, separating personal and corporate activity, and identifying when legal, accounting, tax, or banking advice is required. The objective is not to promise the fastest transaction. The objective is to build a transaction that can be completed, documented, explained, and repeated.
So which funding method works best for international crypto clients in Indonesia? Bank transfer wins for structured transactions. It generally offers greater capacity, clearer records, lower relative cost for larger amounts, and better suitability for recurring or corporate activity. Electronic money and QR-based funding win for convenience. They can work well for small deposits, test transactions, and clients with a verified local account. But national balance and transaction limits restrict their use for larger purchases. Cards remain conditional. A foreign-issued card should never be assumed to work. The platform, issuer, payment provider, identity profile, and transaction type must all support the route. The final answer is simple. Do not choose the method that looks fastest. Choose the method that supports your identity, accepts your funds, fits your transaction size, produces a clear record, charges a cost you understand, and allows a clean withdrawal later. That is not merely a payment method. That is a complete transaction route. Indonesia processed 5.22 billion digital payments in May 2026. Its regulated crypto ecosystem held 21.70 million consumer accounts by April. The infrastructure is large, the opportunity is real, but international clients still need the correct bridge between their money and Indonesia's regulated digital asset system. Bank transfer, card, and e-wallet are not interchangeable. Each method creates different limits, costs, documentation requirements, and risks. Before moving your funds, build the route. For practical support navigating crypto purchases in Indonesia, connect with Sungaza Live through Telegram and WhatsApp at Sungaza Live. Meet us in Kuta near Bali Airport or in Canggu. Sungaza Live, local support for international clients entering Indonesia's digital asset economy.